Right, good morning to our wonderful audience for the very last Boutiques on Wednesdays for 2025. Sadly so, but we've got a really good schedule planned for you for 2026, but we'll get to that a little bit later. What a journey it's been through the year. I mean, we all very keen to take a well-deserved break after a daunting year. But before we do that, we need to make sure that clients are in the right position going into 2026. Traditionally, December is a bumpy month, and the past few days proved exactly that. It's a bit like the weather in Gauteng lately. The one moment the sun is shining, and the next moment you've got a storm and hail everywhere. We've invited Apex Investment Consulting for a bit of a panel discussion and for them to share their thoughts on the macro environment, how the business cycle evolved over the past year and what we're looking at. We're going to look at things like currency risk considerations, long and short-term asset valuations, investment style risks and opportunities, and then that all-known offshore versus onshore debate and what to look for and where to look for opportunities for your clients. To do so, we've invited Chief Investment Officer Tavonga Shivize at Apex Investment Consulting SA and Managing Director Pierre de Klerk. Good morning, Pierre. Good morning, Tav. How are you both doing?
Good morning, Tavonga and Eugene. Thanks, Eugene, for the opportunity, and thanks for having us. We appreciate it.
Apex Investment Consulting is also known as a DFM, so they provide advisors like yourself with portfolio construction ideas and consulting services on asset allocation, manager selection, and the likes thereof. They also provide services to a number of Cat 2 intermediaries when it comes to market-related research. So we thought it well to get them on board to almost like recap what happened over the past year, what worked, what didn't work, but more specifically forward-looking, what their asset allocation views is. But Pierre, we're going to start with you. And like I mentioned in my introduction, it's been a very interesting year. I mean, beginning of the year, there were lots of talks about recession risks still. We knew about the Trump tariffs that's going to cause a lot of volatility in the markets. Yet it's been an exceptional year. All asset classes gave clients phenomenal returns other than global property and maybe India. But it's been a really good year. And maybe if we can start there to have a look at what worked and what didn't work for you during 2025.
Thanks. Thank you, Eugene. And I fully agree with you. I think it was a challenging year for many managers and an interesting year, but really a year of dichotomies, because there was no shortage of geopolitical risk and noise coming from policy and out of the US generally. But against the background of that, there was some serious tailwinds for the market. The AI theme and so forth. So we had this interesting year where, you could easily have stood back at the start of the year and been very kind of skeptical and cautious for a number of reasons. And it wouldn't have been the right positioning because the market, as you said, actually delivered strong returns. Before I move on to what worked for us particularly well and what did not this year, I just want to almost start by looking at how we were positioned and what the reasons for that was, really to pick up on your presentation, because the year also goes quick. And what I did was I literally went back to our Q1 of 2025 presentations to clients and literally physically looked at, what did we say in the packs at the time. And it's interesting how many of the topics are still the relevant topics today. So it is as if a year goes quite fast and many of these things are still with us. So at the start of the year, what we told clients, we expect the dominating macro themes are going to be that, capture the highlights for the year. We listed these 4 things: geopolitical risk and Trump and US policies. And I think that has absolutely dominated the kind of the news flow. Inflation and therefore the interest rate and the yield response to that, and where inflation trajectory is going, we thought was a big topic, and that had remained. Asset valuations, we already pointed out for the last number of years that especially in the developed markets and in the US, equity markets were not cheap. So we were concerned about asset valuations, and I'll chat a bit more about that when I talk to what our positioning were. But we looked at these fairly expensive valuations in some parts of the world, and thought that it's really going to kind of be a noise factor for the year. And then the last one is the tech and the AI theme, and really we talk about it every day, so it almost kind of feels very topical and very new. But it was already a theme a year ago, and at the start of the year, it was already all talk about what the impact of the AI theme is going to be on the tech companies. Now, this slide shows the top-down macro variables and the development of that over time. And I know this slide is later on in the back into Vonga's slides as well, but I thought of showing it here as well, because we do follow a mix of a top-down and a bottom-up approach. And really the rationale is that, bottom-up speaks a lot to valuations, but wherever you want to invest in the world or in an asset class, you want to know whether the top down is a headwind or a tailwind, and that informs much of your overall risk stance. And just to quickly say how to interpret this graph, it's measurements of the economic variables that are then standardized onto a score scale of -3 to 3, and 3 means it's a strong tailwind, things are good. -3 means it's a headwind from a macro top-down point of view, and things are not so good. And then when we look at all the different lines on the slide are the main kind of macro elements we look at: inflation, monetary policy, fiscal policy, geopolitical risk, and so forth. So maybe just to use this as a guidance as to what set our kind of overarching risk appetite over the last few years and into the start of this year. And as you can see, after we had a lot of stimulus and support for economies and markets post-COVID, you can see all these positive numbers. That means all these metrics were supportive. And on the positive side, immediately post-COVID, we had this kind of downtrend in most of these variables. So inflation as a score deteriorated meaningfully because inflation shot up, and therefore monetary policy followed. It became less accommodative. Rates were increased first, and so forth. So when we came to the end of 2024 and the start of 2025, we were in this position that we had a few years already of economic kind of sideways movement or slight deterioration in the variables, and particularly geopolitical risk was a significant risk item, and inflation had stabilized, improved a bit from its highest level, stabilized a bit, but were still, significantly above long-term trend and where they wanted it. So that's where we started the year. We started the year with a view that monetary policy is looking as if it's turning a bit more accommodative, but we worry that the Fed will still worry about inflation, therefore don't necessarily deliver the cuts expected, that might put pressure on the market. And we weren't sure whether the Fed in the US were going to prioritize growth or prioritize fighting inflation. Now at the end of 2025, we're at a point where it seems clear that they are prioritizing growth and the slowing of the economy. And that's why they're on a cutting footing. But at the start of the year and before that, it was much more uncertain whether they're going to prioritize growth or the fighting of inflation. So I think it's these three things: the fact that the metrics had been slowly deteriorating, inflation was still much more of a concern maybe than what it currently is, and geopolitical risk was very high, that on an overarching view kept our risk appetite neutral or slightly more defensive than neutral, but certainly not overweight in risk assets. And the other important driver of that view was recession risk as gauged by the yield curve shapes, for example. So our regular clients that we interact with on a quarterly basis will know that we look at the shapes of the yield curve as a meaningful indicator of recession risk. And the yield curve was deeply inverted, then it started uninverting and the shape started improving, but it had not reached kind of complete normalized levels. That's the first point. But the other point, and that's what this graph shows of the yield curve in the US, the other point is that historically, apart from the fact that an inverted yield curve was a good recession signal, what often happened was, as one can see from the slide, was that even when the curve had normalized, had uninverted, you still had a recession. So the message we mentioned to clients was that, once the yield curve inverts or uninverts, return to normal shape, it's kind of good news, but you mustn't think it's an all clear green light signal, because often in the past, you still had a recession afterwards. And the reason why that happens from an economic interpretation point of view is because the normalization often happens because the short end drops away, it falls, and therefore the yield curve steepens. But the short end falls because the Fed that controls short rates realized the economy now needs a lot of help, and the damage had already been done. Because we know the Fed always says interest rate adjustments or monetary policy works with long and variable lags. So the risk is always there that it's too little too late once they cut rates, and that the damage are effectively done, and therefore you still end with a recession. So this is another reason why we were not kind of completely relaxed about recession risk. The risk had improved a bit, but there was still some residual risk, and that kept us from being more aggressive, certainly kept us from being overweight. So we still had a defensive stance, which we incrementally loosened during the year. So in the next point, we'll discuss how our views changed. And it is so that we incrementally added risk back to portfolios, and particularly we added risk back after the market came off in April. But throughout the year, we were kind of in a normalizing footing, but coming from underweight towards neutral, not going overweight yet. So those were the points that informed our high-level kind of risk appetite, and how that looked when we set it onto portfolio positioning. We were marginally underweight SA equities, but the meaningful underweights were towards developed market equities and specifically US equities, where we could control it, because that is the most and was the most expensive markets even at the start of the year. We had a slight underweight to EM equities, but that was paired with an overweight or a position in Chinese equities, which worked out very well for the year. I'll show just now. So overall, we were close to neutral, and where we were underweight, we were moving towards a neutral position in emerging market exposures. The residual underweight to the US and developed market equity was essentially sitting in domestic fixed income and in global fixed income and in gold as a protection against all those risks that I mentioned. So this was our positioning. Overall, we were slightly on the defensive side still, and the progression and the footing during the year was to incrementally increase risk. So how did all of that work out? That was your question. How did all of that work out for our portfolios? And it had actually worked out reasonably well for us. If you look at the table that shows the different performances on a one-year basis up to the end of September, then you can see at the top many of the positions where we had portfolio overweight or positions did quite well. Gold miners and gold we know about, and South Africa had particular benefit from that economically as well as our market. Chinese shares did well, and we had that position for a while, which was not fully rewarded, but that happened in this year, so that worked out well for us. The fact that we weren't materially underweight SA equities worked well. The fact that we had emerging market equities in an overweight or at least a neutral worked well. Certainly versus some peers that were lighter in that. And as you go down the list, you can see global equities and US equities actually marginally underperformed emerging market equities. So that view was correct. And even in the South African context, our exposure to bonds, given the attractive yields that it offered, actually paid off quite well during the year. So our view was really on a risk-adjusted basis. If you want to be a bit defensive towards equities, South African fixed income offer you really good kind of fairly guaranteed returns, and it makes sense to put a bit of your portfolio in that. And we had these what we call kind of buffers or defensive buffers in our portfolios, which was invested in South African fixed income, and we used the flexible managers for that, and they all delivered kind of double digits and a bit higher. So we did quite well from that. What did not work, I suppose, that well in our portfolios is our exposure to global fixed income. So far, global yields went up a bit this year on concerns about US fiscal sustainability into the long term, and maybe some residual concerns about inflation. So we also view that as a defensive asset, and in fact we've added to our inflation-linked or TIPS and ILB exposures, as Devonga will mention later on. So it's been unrewarded so far, or not that well rewarded, but we've actually added to some of those positions because as inflation has moderated even further, the real yields that you can get from those asset classes have actually improved. So our view would be that the majority of our directional positions actually worked out reasonably well and was well rewarded. Maybe a last point on the currency as well. We've, for a period of time, had the view that the rand is weaker than what it should be, that we near or at the top of a dollar cycle, and the dollar did weaken during the year and the rand did strengthen, and therefore our position of not being at maximum foreign exposure, but being somewhere in the mid-30s at max was also the correct call in that sense. If we look at the manager styles, I'm not going to say a lot about it. This just ranks how the different investment styles performed over the 1 year. But the point to make is that as multi-managers, we favor a multi-style approach to things. And if you had been invested in multi-style or multi-factor, it worked out quite well on the local side and also on the global side. What caused the most pain in portfolios and for our clients have been the underperformance of the quality managers, and specifically the global quality managers. And it's typically because they weren't in the tech-driven growth shares. And I'm sure Tavonga will talk more about our view on that and why we believe it's sensible to maintain them. But this is really just to make the point that it is difficult to call styles, and therefore a multi-style approach is often a very robust way of going about things. Back to you.
And it's exactly that. And I mean, your next slide speaks to that. And you did mention, at the beginning of the year, there was high levels of uncertainty. And with hindsight, if you look at the numbers now, we should have had more gold, should have had more SA equity. But how did your investment ideas change during the year? And maybe briefly touched on what informed those changes.
Thank you. If we look at this slide, it shows the long-term valuation scores of the different geographies and asset classes, and it compares it to 2 years ago. So what you can see is 2 years ago, much of this was much more towards the left. So there was a lot of opportunity where markets were cheaply valued, but some markets were already expensive. Developed market equities and US equities, as I mentioned, 2 years ago and a year ago, at the start of this year, was already on the expensive side. Markets had gone up over this year and we've had good returns, but the effect of that has been that stepwise, all of these things have become more expensive. So in terms of how our views have changed, that leaves one with a bit of a conundrum, because as the market run up, and there's a lot of momentum in the market, especially if it's quite narrowly driven, but it becomes more expensive. It's very difficult to change your view to chase that momentum, because if you fundamentally base as we are, then you reflect on these valuations and you say to yourself, listen, just because the party is red hot, but it might be towards the end, and there's an increased chance of a breather in markets, it's not necessarily the best thing to chase this. So in terms of how our views have changed and what ideas have changed over the year, I would say not dramatic. I think, as I already mentioned, we incrementally increased risk, but coming from a more significant underweight position as we saw the macro environment stabilize a bit more, even though it doesn't get kind of bright green scores. There's been some improvement on the inflation front, certainly, and the rate cutting cycle in the US had started. So we incrementally added to risk. A big thing that we did act on was after the market came off in April. We added, we measured the fall in the market, and we had certain trigger levels. And as we reached those trigger levels, we added risk back to the portfolio. So I think from a pure tactical response point of view, that was a good response. And then, as I mentioned much later in the recent quarter or so, we've added to inflation protection and ILBs. Not necessarily because we have an alarmist view about inflation, although there is still a bit of a question mark around that, but more so about the fact that as the yields develop, they are actually offering you very good real forward-looking returns. So they lagged. It's quite intuitive that the asset classes that have lagged in performance are the better valued ones, and arguably maybe offer you the better return opportunities going forward. Our response to gold during the year has been to trim into strength. So as the gold price and the exposure of funds to that ran up, we trimmed back to our neutral setting, or to our strategic setting, our exposure to gold. And I think that was also a good way of responding to how the gold market continued to move upwards. I think that is my brief summary of how at the margin kind of we made changes during the year, but nothing too dramatic.
Pierre, I know Tab's going to touch on the investment process a little bit later, almost to set the scene. What is that recipe that you guys follow to make sure that you get to suitable answers? You can't always get to the best answer, but the best possible informed answer. But you've got your own internal investment process, but you also get inputs from the likes of the bank credit analysts, Alpine Macro, and I know you also get a lot of input from some of the top fund managers in SA with regards to asset allocation views. Did your views, if you look at your process, differ significantly from the input you get from around the globe and from SA fund managers?
Thanks for that, Eugene. And it is interesting that what makes a market is different views, and often opposing views or materially different views. And I think this year past, BCA versus Alpine Macro was a good example of that. And just to recap, these are both, in the top 3, or certainly in the top 5 most highly regarded research houses in the world. And we get research from both of them, as you say, but it was very interesting in a year like this year that they did have quite material different views. And it actually goes back a bit further than just this year. And to summarize that very shortly is to say that BCA has been much more concerned about the possibility of a recession in the US compared to what Alpine Macro maybe had been. So BCA have consistently over the last year been advocating for an underweight equity stance, because they felt that there's a probability for a recession in the US. And they often made the point that in a proper recession, the equity market can come off by 30 or 40%. So they viewed it in a serious light, but they also changed that recession risk probability up and down as new information came about. So at some point, they had the recession risk at quite a high setting, but that developed over the course of a year to now a recession risk call from their side of maybe between 20 and 30%, but not off the table yet. And therefore, they are still a bit on the cautious side. And what you can see on the left-hand side of this slide is their positioning at the start of this year, what they were advocating for. So they were underweight equities. So maybe in direct answer to your question, our view was in many respects a bit closer to BCA rather than to Alpine Macro. And I'll point out now how it differed. There was points of difference with BCA as well, but in an overall high-level risk stance, I think we're a bit closer to BCA for reasons of residual recession risk, as I already mentioned, and also the valuations of asset classes. So they advocated for underweight equity, overweight fixed income. We had a more positive duration view than them. They were neutral on fixed income, more positive on cash. We were more positive on duration. They were also overweight the US, which is different from us. Our positioning within equity has been underweight US and developed equity, and rather overweight within developed equity other areas, Europe and Japan, and then definitely in emerging markets. They were not positive on emerging markets. That's another point of difference between us. Sector-wise, they were more on the defensive side. Within fixed income, they shared our view on duration and inflation protection. They were overweight the dollar, or more positive on the dollar, and negative on EM currencies. So that's another point of difference. As I already mentioned, we essentially had the opposite view. We thought the rand could strengthen and the dollar could weaken, and that turned out for us. We shared their view regarding gold. Alpine, and I just kind of said there on the top right what BCA said at the start of the year, and as you can see, they were fairly kind of cautious. Alpine Macro, in comparison, the bottom right-hand snippet from their start of year report says that they expected the market to correct a bit, but after that they foresee new highs, and effectively that worked out well for them, that view. And really, in a nutshell, they were less concerned and remain less concerned about the risk of a US recession compared to BCA, and they are much more verbal about the fact that we might have a melt up in the technology space, or a continuation of the run up of the market. And they compare it to the late 90s, and they point out that many of the things that we see happening this year has analogies to the late 90s, positive and negative. On the negative side, maybe one can mention that there are a lot of money being thrown at tech companies that are not necessarily making revenue and are not being profitable. What is different from the 90s is that the good tech companies are making a lot of earnings, and that's why the market kept on going. But the more negative analogy to the 90s is this froth that we see appearing in the market, especially when the shares of unprofitable tech companies in the Nasdaq and companies that don't make revenues kind of also lift, and sometimes even lift higher than the other companies. But Alpine Macro was a lot more into the risk theme. They had an overweight equity setting. They were less concerned about recession, and they thought we might have this kind of melt up and bubble forming in the tech space. And effectively, we're not quite there yet, but they're sticking to that, and we might still experience it. So I think we were a bit closer to BCA overall, but I think what we positively took from Alpine is the view that the market can stay irrational longer than what you can stay suspicious or skeptical and out of it. So our response to the tech theme, for example, was to, rather than investing in a tech ETF or a tech fund, which maybe would have been a bit more kind of adventurous, to rather play it through the growth managers. So we had exposure to the theme, and I think we took that from Alpine that, you can't fight this market if it has this kind of momentum. There are strong earnings for many of these companies, and we did ensure that we had some exposure to some of it. In terms of how we compare to the peers in South Africa, and I'll keep that very brief, there was a wide range of views. Some managers were a lot more skeptical about the SA prognosis. They ran maximum foreign exposures. There were another set of managers that were a lot more positive about SA equity, specifically SA Inc., the improvements on the SA economy side, and they were similar to us, not at maximum foreign exposure. So I would say we were kind of in between. The managers that we interact with on the flexible fixed income side made very good arguments as to why they can generate good returns from SA fixed income if you want to include that as a defensive buffer. And we bought, we shared that view when we bought into that, and that worked out well. For us. I think I'll leave that one there for that question.
Yeah, thank you very much. There's some interesting questions coming in from the audience, but I suspect we may cover some of them, so I'm going to park them for now, but I'll get back to it. Pierre, very last question for you before we head over to the forward-looking views with Tavonga, and it speaks to trying to avoid traps, because beginning of the year, mega caps, AI stood out. And we've seen some portfolios where clients heard towards that for all the right or wrong reasons, having high concentration in that. We've seen it a bit with gold. It's almost that FOMO, I'm going to lose out, so people are loading up on resources and gold exposure. But how do you manage concentration risk in portfolios and almost try to avoid having too much exposure to something in case it doesn't work anymore?
Yeah, thanks for that. The market has been driven very narrowly, and there was a lot of concentration around the tech space, for example, in the US, and around gold and platinum in South Africa. And gold and platinum makes up, I think, 26 or 27% of our market. So clearly that was a swing factor. Our view has firmly been that you can't approach these things in a binary way, and you have to be pragmatic. And I think the kind of portfolio construction responses that we followed to deal with that was, as I already mentioned, to not be completely out of tech, but to play it through the growth managers as an example, where you get a bit better diversification, as opposed to investing in the market cap index, where the biggest companies just kind of start dominating the index level. So I think that's a good example. I think our use of a combination of market beta exposure versus factor exposure and diversified style exposure, where again you build in some natural diversification against beta only concentration, was the way of doing it. And that really kind of speaks to the global side of how we deal with it, but also on the local side. So if you think about the concentration of gold in our market, the fact that we are multi-styled and we invest in managers of all the different styles also naturally implied that we use some managers that were not as heavily exposed to the gold theme. They might have lagged, and maybe some people almost also say disappoint us for the year or so far, but one sees it in that context, that those managers are your insurance elements against a theme that are kind of becoming expensive and more expensive and more expensive. So, it is a bit of a dodging the bullet kind of answer, in that, clearly a response to high concentration is not to throw your hat in either corner to say, listen, I'm either going to chase the momentum, or I'm going to sit on the sideline and wait for it to play out, but not participate at all. I think both of those things have their own risks, and we try to hit a pragmatic balance between them. And I think that's the strength of multi-management, that you can build portfolios across multiple styles as a response, for example, or you can blend market beta passive that gives you the kind of the exposure to the concentration, but you can blend it with factor-based, for example, or equal-weighted passive that dilutes it a bit again. So one really just try to follow a risk-aware response to it.
Yeah, thank you very much for that, Tavonga. I've kept you waiting very patiently. We're going to step off the recap of what we've experienced, and I think this is what we really want to get to. If you can maybe start sharing from your side, and then we're going to start to look at almost from a macro point of view. What are you looking for at the moment, and what do you identify at the moment?
All right. No, thank you so much, Eugene, and thank you so much, Pierre, for that. I think maybe one thing I'll share with you, Eugene, is we often have, we actually have an investment principle or guideline within our philosophy and process that valuations or asset valuations are a very poor market timing tool. And so typically what works best, if whenever you say outlook and we think of valuations, we immediately reminded how, as far as timing is concerned, they do not do justice to an outlook. So another way of looking at this is that it's very possible for cheap asset classes to sell off and perform poorly when the central bank is hiking rates aggressively. Equally, it's possible for expensive asset classes to continue to do well because the central bank was cutting rates. So you get a sense where in the immediate short term, the policy stance can dominate asset class valuation significantly. So whenever you sort of ask me of outlook, it's very clear based on the analogy I've given, if you believe in it, that the probability of getting it wrong is very high if I skew my views to be informed by valuations, and maybe the odds of getting the outlook more correctly a little bit higher if I skew it to policy. So you would know this particular house represents our global macroeconomic house view. And if you sort of look at the five main areas that are sort of in this house, it really speaks to economic growth, which is the most important, inflation, monetary policy, fiscal policy, and geopolitical risk, which looks at everything that is extremely unpredictable, difficult to call, and difficult to pre-position for. Our general economic mantra is that monetary policy and central policy is incentivized to maximize economic growth for as long as inflation is not a problem. So the more you ask me what is the outlook, I immediately go and say, is monetary policy and fiscal policy constrained by inflation as we head into 2026? So the first port of call would be the inflation picture. And the inflation picture is this orange line, I think, Eugene, where I'm sort of like moving with my cursor. And the way to read this chart is we really use it to inform our tactical asset allocation, where any score above 0 would suggest that the specific variables are very positive, and they suggest that we should have a very aggressive risk positioning. And everything underneath 0 would say you should be very careful as far as growth is concerned. So you can see the inflation picture was very much anti-growth oriented policies, pretty much, I think, from the first quarter of 2022, and has remained like that until recently. But I think it's a fair comment to say this is probably the better inflation readings we've seen. If you look at where we ended off this quarter at relative to almost 3 years ago. And on the back of this much improved inflation picture, we saw in the third quarter of this year, which is pretty much around September and October, the Fed make a very strong statement to say the time has arrived for them to stop focusing on inflation and rather focus on the labor market and defending growth. And you saw pretty much almost 95 central banks rally aggressively behind the Fed of America, so much so that we had an unprecedented improvement in the global monetary policy backdrop, where the score improved by 200 basis points from -1 to almost +1. If you look at fiscal policy, the blue one, this is also very constructive with the blue line, so much so that when we now look at the underlying growth, which is the yellow line, for the very aggressive shift in monetary policy combined with an aggressive fiscal up the global economic growth variable to marginally above zero. So we enter 2026, or we close 2025 with a very aggressive and pro-growth fiscal and monetary policy that has just managed to lift growth above zero. And on condition there is no drastic change to that type of policy stance, I think it's going to be a great year. We are not expecting any drastic change to those particular numbers for three main reasons. If you look at the recently appointed prime minister in Japan, they've announced a very aggressive fiscal policy for 2026. If we look at the USA, the One Big Beautiful Act is effective next year. And then if you look at China, as I'll show you later, they've just literally gone through the 15th five-year plan effective from 2026 to 2030. And economic growth is one of the major orientations. And if you look at South Africa, and we look at what the recent adoption of the new inflation target by the National Treasury and of cutting risk, we're also having this beautiful support and coordination between fiscal policy and monetary policy to support growth. So Eugene, we're actually quite excited that we're closing this year where the central banks that matter to a Regulation 28 portfolio are pretty much pro-growth, lifting up growth, which means that our general investment strategy enters 2026 in a pro-growth fashion. Obviously, some of the data we're talking about historic. It has not escaped the shutdown that lasted over 45 days. So we're expecting a lot of it to continue to be updated more accurately this month going into next year. But what I can show you in this particular picture, this is the regional growth picture for the geographical regions that matter again to a Regulation 28 portfolio, this being emerging markets, China, South Africa, etc. What you can pick up, Eugene, is as we close the year, there is no geographical region whose growth variable was negative. So that's a very good plus as far as the outlook is concerned. The only exception, as you can see, is China, where that number is pretty much an anomaly, I think, compared to the rest of the geographical regions. But again, we're not very concerned as far as China is concerned. You can see as of yesterday, we're starting to, which is the 2nd of December, starting to see details trickle in of what was being discussed during this 5-year plan. And I think basically what they've agreed to do is to really focus on development, security, and domestic demand. The Chinese consumer sits with about $5 trillion worth of deposits, which is equivalent to the economy of Japan. And they really cannot spend that because they're lacking confidence and policy has not been supportive. And the government has made it their goal, their agenda, their focus to ensure that that $5 trillion is spent in the next 5 years. So, I mean, to keep it short, for looking at policy alone, Eugene, we close in a very beautiful spot where the central banks and the National Treasury offices that matter to a Regulation 28 portfolio, very constructive as far as growth is concerned, which means we're pretty much entering 2026 with a pro-growth stance across the various geographical regions we invest in. I think that'll stop at this point for now.
Thank you very much. I think that slide actually into my next question, and that is, what are some of the investment ideas that really stand out for you going into 2026, given this pro-growth background?
So what you want with this pro-growth background, Eugene, is want valuations to collide with policy support. But the investments is such a tricky thing because if you say the investments market preempts or discounts policy, you never really quite get a scenario where valuations and policy support align. It's very rare. And I think this particular chart, does justice to what I've just said. 2 years ago, everything was extremely cheap, but policy support was extremely restrictive. So you had the valuations, but you didn't have the policy support. Now, fast forward to today, policy is great, but you don't nearly have the same extent of attractively valued opportunities that you had 2 years ago. So I really just want to leave you with that to say the valuation opportunity that can respond to this great policy is significantly smaller today than it was 2 years ago. However, as soon as I make that statement, we kind of now quickly need to say, let's not forget that a lot of our conversations will always focus on a Regulation 28 portfolio. And maybe let's just make it very specific and say we're looking at a balanced fund. So what type of opportunities are going to work for a South African balanced fund going forward, given that policy is a given? If I look at this particular chart, I easily have 45% of South African equities. So if you ask me of ideas, I would definitely list South African equities because everything else is kind of like amber to pretty much dark red. And then if you look at the next idea, South African property, that's easily 5% in a Reg 28 balance fund. So already 50% of the opportunity set is well positioned, I think, to benefit from the for policy stance. If you look at Chinese equities, these easily have a strategic exposure of 5%. That's 55%. And then if you look at global property, that's again another 5%. That's 60%. And then if you look at the US small and SA US small mid caps, obviously tallying with SA small mid cap, you could easily look at another 5%. So Eugene, what I like about this particular chart is that as much as we don't have the same dripping rust of opportunities that we had 2 years ago, we easily have 65% of equity type ideas that will benefit from the very great policy stance we're seeing currently. But remember, I'm just talking about equity ideas, and 65% can benefit from this, which is a big number, obviously, for a balanced fund. We're also aware that a balanced fund can typically allocate about 10% to long-dated bonds. And if I look at the real yields, the great news is that we've had a beautiful rally of almost 100 basis points, which is translated to very strong double-digit returns for bonds on the 5-year, on the 7-year. But what you can see is despite the significant drop in yields, we're pretty much still operating outside the 1 sigma band, suggesting that the outlook or the runway for real rates remains extremely impressive for a Regulation 28 portfolio. Remember, I already have 65% equity ideas in the bag that have got beautiful policy support. And then now I'm sort of adding another 10% from nominal bonds. So I've started off with the 5-year and 7-year. If I move to the 10 and 15, again, very attractive opportunities. And I move on to the longer dated bonds, the 20 and 30, very attractive opportunities. As you would have seen from the slides that Pierre showed you earlier on, we are 2.5% overweight nominal bonds. The strategic weight is 10. So already I've got 65% from equities. Add another 10, I've got 75. Add the 2.5% overweight, I'm sitting at 77.5% ideas for Reg 28 portfolio that can do well. Can we be greedy and push that number a little bit higher? I think we can. If you look at South African inflation-linked bonds, again, starting at the short end of the curve, they have been stuck with very good yields, but poor performance. As you can see, there's not as much movement here as you've seen in nominal, but the fact of the matter is the valuations look good and policy support behind this looks really good. So, and then if you start to move to the longer end of the ILBs, then the opportunity set becomes a no-brainer, extremely attractive with significant room for value unlock. And then if we sort of finish off with the longer dated ILBs, again, you look at a good idea. So far we've got about 75% worth of ideas. A balanced fund can allocate about 5% to ILBs strategically. That takes us to 80. We currently have a 2.5% overweight to ILBs in our portfolios. That takes us to 82.5. So, and I think if I look at this, Eugene, there's quite a lot of beautiful ideas that we have in the portfolio. I just want to stop and just talk about Chinese equities for a little bit. We were exposed to this idea where we've got a strategic exposure of 5, and I've already counted it into the 82.5 I'm currently at. And this particular idea pretty much was going nowhere slowly until the inflection in September of 2024. You would know that in a lot of the presentations we give, we're very obsessed with defining a correction as a loss of at least 10, but not more than 20 over a 3-month period, a bear market being a loss of over 20%, extending 3 months and above. But hardly do people look at the positive definitions, which is a bull market, which is an inflection of at least 20%. Lasting over 3 years. So we had this beautiful inflection in September 2024 of 20%. Then the idea gave us nightmares because it got stuck there and there was no conviction that it's going to get better. We then had the Chinese technology shares, which you can access through Satrix, Miski China. You can also access this through the BCI Chinese Equity Fund, the Rescura BCI China Equity Feeder. This then went in a very convicted way into bull market territory. but our A shares pretty much defied this until this particular last quarter. So you would know from the charts that Pierre was talking about, we've got a 2.5 to 5% overweight Chinese equity. And based on the ideas I sort of mentioned earlier, we're already sitting at 82.5% of a regulation 28 portfolio. And if I add the 2.5% of Chinese equities, we're sitting at 85%. So if I sort of close off and say what sort of ideas are we looking at, the combination of South African equities, South African bonds, the two universes of Chinese equities being the A shares that you can get through Prescient, the H shares that you can access through the BCI Riskura China Equity Fund, SA Inflation Linked Bond, you're pretty much looking at 85% for the first four ideas. And then if you then bring in global inflation linkers at about 2.545%, a bit of global bonds and a bit of global bonds, global gold, you pretty much get very close to 100%. So I guess what I leave you with is that the valuation picture is not as juicy as it was 3 years ago, but we can easily identify ideas that make up 100% of a Reg 28 portfolio, which have got beautiful support from a policy perspective and very good valuations where the earnings can continue to benefit from strong policy support. So it appears, Eugene, as far as the Reg 28 balance fund is concerned, these are the ideas we're definitely very excited about heading into 2026.
Thank you very much. It all sounds very positive. And like you mentioned, a lot of policy support going into 2026. But what about things like a recession? Because, Pierre also showed some slides beginning of the year. The likes of the BCA were still, very negative on growth assets, given possibilities of a recession. And looking at the US, is that still something we need to worry about, or do we just ignore it?
We definitely have to worry about it. So our mantra is we will remain neutral growth assets unless the risk of a recession rises notably. So I always just want to use a Reg 28 balance fund because it makes everything so easy, but we can obviously use a cautious fund and a moderate fund. It will not change, I think, the narrative. But maybe let's stick to the balance fund where, the local equity neutral allocation is about 45. And then global equity is about 20. And then you add 5% local property and then 5% global property, you're pretty much sitting at about 75% growth assets. So our mantra, Eugene, is to stick to 75% growth assets plus an overweight allocation unless the risk of a recession rises notably, really because most of the times your significant bear markets overlap with recessions because typically your earnings contract there. Now, where do we stand in terms of that? We are very aware that as far as the Fed is concerned, and Eugene, I'm going back to the Fed because whenever you ask me a question where I need to think very short term, I quickly remind myself that I'm not going to use valuations to answer you because valuations are a very poor market timing tool in the immediate 3 years. So I always go to default to policy for that particular reason. If I sort of ask the question, what is the Fed concerned about, and does it concern them to change this policy support I spoke about earlier, I immediately look at this particular chart where recently Jerome Powell has been communicating that the weakening trends in the labor market are of great concern to him. If we look at one of the signals that is related to a recession from the labor market is the aggregate hours worked. And you can see that as of August 2025, this has moved into negative territory. Unfortunately, after that, we got locked into this whole shutdown. So the data coming here is not reliable currently, but we get a sense that the labor market is moving in a direction that is extremely concerning to the Fed. And then if we sort of look at the chart that I sort of have following up, you realize that if you go back, Eugene, to January 2024, and you look at the 12-month period to January 2025, you will realize 12-month forward Fed rate guidance was always at least 2% above the 12-month inflation projected by the swap market. This is another way of saying for the 12 months to January 2025, the USA central bank was running what we call aggressively elevated real interest rates. The reason being that they wanted to induce a recession in order to moderate inflation. I think that was essentially what it was. And then if we move on to January, it would appear that as your inflation guidance increased a little bit, the fourth guidance reduced a little bit, meaning that ordinarily, Eugene would have expected the Fed's 12-month guidance to rise as the swap market was saying inflation might be a problem. Instead, the Fed actually was guiding lower. And this was a communication throughout this year to say the Fed is concerned that inflation is no longer the area to focus on. It should actually be growth. And this is something they started to do in January. If you look at how those lines were closing instead of maintaining that 2% gap, it got to a point where around May or June of this year, the Fed decided to run what we call a negative real rate policy, suggesting that the policy stance has moved away from causing a recession to defending a recession. I sort of bring this point across because I want to address the point to say, is there a risk we're going to lose this policy support because of recessionary effect? Looking at this chart, it looks like the policy support might be increased a lot further. So one of the biggest developments to happen in the last 6 months of this year is this confirmation that the Fed is walking away from running an economy with real positive real rates and want to depress real rates across the entire global market space. So this is where ideas that still have positive real rates like South African bonds, South African IOBs, global IOBs, global bonds, global property become extremely attractive. But however, let me just quickly look at hardcore signals and everything concerning our process. We know that when the Fed is running aggressively high real rates, they're pretty much tightening the economy and they're trying to induce pretty much a correction in growth and growth assets. And typically the red arrow that I'm sort of looking at right now would have been pointing towards the direction of a market crash, which obviously then comes to a crash. However, this time around, the Fed has changed where they are moving away from tightening and they want to expand the economy by running negative real rates. We also saw how China has been moving away from a bounce and is trying to move into expansion. So as far as recession is concerned, Eugene, we stand in a place where we see the two major economies forcefully driving their economies into expansion, which automatically confirms to us that the risk of a recession, although not completely eliminated, is one that these two major central banks are trying to get rid of as we get into 2026. And again, you can see in this expansionary type of regime, we become very aggressive on growth assets. We are not as trigger happy languaging and my energy suggests. We still try and figure out for caution. And these are the three traditional recession risk signals that one looks at: the 10-year versus 2-year, 10-year versus 3 months, and 10-year versus and the Fed swap. And they're pretty much reading a signal of -1, which has got an element of saying exercise a little bit of caution, although policy support is now firmly on your side. So as far as the recession is concerned, Eugene, I think you can tell that it's no longer the biggest concern in our positioning. But when I sort of went through a lot of the things that I discussed, I sort of added a little bit of global IOBs, a little bit of global bonds, a little bit of global gold, a little bit of SA IOBs. Those exposures are about 15 to 20% of our portfolios. And on the one hand, they give us attractive real yields. On the other hand, they are pretty much our best defense if the recession risk increases materially. So still present, but not the central focus point for our portfolio positioning.
Tav, you did allude to some of your asset allocation positions now, but for interest sake for the audience, I think can we unpack that a little bit more specific what those asset allocation views are. I know we are cautious for time; the clock is chasing us, but maybe just high level, what you're thinking right now.
So we run a 4-factor risk-adjusted asset allocation process, and the factors we look at is the factors that drive performance in the immediate short term. Global macro, I've really exhausted this, and essentially the message there is there's strong fiscal and monetary policy support. The global regime is a recession risk, and I think you really helped me to this is reduced quite materially. Currency risk, because the growth in the rest of the world is improving, we find the dollar on a weakening trend and obviously the South African rand on a strengthening trend, and we're sort of adjusting for that. Valuations, I sort of gave you that sad picture where there is opportunities, but we have run out of dripping rust. So when you bring all of those four together, and you start to get a sense of how do valuations look like. You get a sense, Eugene, where if you look at all my asset classes at the top, I've got South African equities when you adjust them for those four risks looking fairly valued. So we'd be sitting at a benchmark weight. South African property is fairly valued. So we're sitting at a benchmark weight. Low duration fixed income risk is fairly valid, but we've shifted this more to high duration risk, which is also fairly valued because of that rate cutting cycle. And then if you look at emerging market equities, we've got marginal underweight, but this negative score is because prices have run ahead to predict an earnings recovery, which we think is going to play out. So we're pretty much not as concerned here. And then Chinese equities were fairly valued. And then the later clocks are pretty much all the offshore ideas, primary developed markets. And you cannot miss the fact that this is where you're getting the negative risk adjusted scores. And it kind of creates a sense, Eugene, where we are pretty much pro SA, pro Chinese equities, and not because we're South African, but when we adjust for those four different risks, the opportunity set is firmly moving and shifting in favor of South Africa. Eugene, you do know I can give you a little bit more charts, but I'm now working with your time. I think this is a very good place to stop as far as outlining what our asset allocation skew currently looks like.
Lunga, thank you very much for that. I'm going to take one or two questions from the audience very briefly. In a nutshell, because I know you favor China, I know you also looked at emerging markets. What about places like India?
So India is a very interesting one, right? So we've just really had I think great interaction with about three Indian equity managers. What you get out of India is that the underlying earnings story is not broken. So, for example, I think the average Indian company has got a 3-year internal rate of return of about 20%, or earnings growth rather of about 20%. The monetary policy is not really in a bad place. It's just a country that is suffering indigestion, where it rallied way ahead of these very strong earnings, and it kind of needs to like fix its let's call it a tummy ache until it doesn't like feel or get rid of the nausea that it's feeling. Once this tummy ache is addressed, Eugene, which means that the valuations have to moderate a little bit better, then I think the Indian opportunity will start to do well. We're very aware that it makes up about 15% of the EM equity index. The earnings are super good. The valuations just need to correct a little bit. And it is one of the reasons why we are constructive on it. It just needs to get past the current tummy ache and nausea that it's facing because things were a little bit overdone. Otherwise, an excellent opportunity from a forward-looking perspective.
Lunga, you spoke about the Fed and the cutting cycle. One of the questions from the audience as well, and I know it's a going concern all over, is the extremely high debt levels globally, especially that of the US. How does the debt in the US, or how can it possibly impact on the decisions the Fed makes going forward?
Eugene, so the way I understand our debt is more from a debt to GDP perspective, right? And I just always want to say, if I come to you, Eugene, and I say I've got a house worth 20 million and I owe nothing, you could easily say that my net worth is 20 million or else equal. But if I come to you and I say I've got a house with 20 million, but I owe 40 million, you would say my net worth is a negative 20 million. So if I have to issue any currency, it has to be 20% depleted. So I think the US conversation where the debt to GDP is about 120% to GDP or whatever it is would mean that the dollar is no longer worth that much unless there's a strong plan to address that debt that the market sort of looks at. At this point in time, we're not sort of aware of any besides the one big beautiful act which makes that worse. So it does put a lot of pressure on the currency or else equal. As far as the Fed is concerned, they don't really have to do anything unless the weak currency causes inflation. If the currency weakens, but it doesn't cause inflation, they don't have to do anything. So I think ideally that should translate into currency weakness. And if currency weakness is inflationary, the Fed will respond. If it's not, the Fed will not respond. But it definitely does have a debasement of the dollar.
Very insightful indeed. Pierre, I've got a question for you from the audience, and it speaks to overall portfolio construction. And given your asset allocation views, do you at all use alternative funds or hedge funds in portfolio construction? And what is your views on the use of alternatives when you build portfolios?
Thanks, Eugene. First point is that, we certainly are positive about the uses of alternatives kind of structurally and strategically, because one is always looking for different return drivers and uncorrelated assets. And, that's exactly what the name alternatives refer to. But to be a bit more specific, hedge funds, specifically multi-strategy funds, disappointed this year so far. And, we're aware of that. And I think our recommendation to clients where they have exposure to that would be to keep it. It is kind of your insurance policy in a way. And they underperformed because of the concentrated nature of the market. And as the market performance broadens out, those funds will likely perform better. And obviously, if there are significant market corrections, then hopefully the fact that they can protect the downside will also mean that they contribute. I think other alternatives, gold is interesting, because if you're a holder of gold, it's easier to hold on to it than what it is to commit new money to gold positions. But there is, as listeners would know, and as you would know, strong arguments about the continued central bank buying support for gold. So ourselves and the macro researchers that we referenced still have a positive view on gold, maybe not tactically in the short term because of the high valuation, but certainly into the future. There seems to be an underpin from central bank buying for the gold price. So I think gold has a place to play in portfolios. Other commodities as well. We have natural resource fund exposure on our portfolios. It may be in the future will be more around the rare earths and so forth, not necessarily the old kind of industrial linked commodities that does the best. But I think commodities are important. And then private credit is very topical globally. We don't necessarily include it because our kind of regulatory regime in kind of CIS portfolios not necessarily allow for it. But I think one must be a bit careful about that. The research that one reads kind of point to a bit of caution around the global private credit market. And then crypto, which again, we don't include in the portfolios currently, but keep a keen eye on. I think the issue with crypto is that one desperately wants it to be an alternative asset in the true sense of the word, that it offers you diversification and behaves differently. And therein lies the current problematic that so far, the main cryptocurrencies kind of behaved similar to risk assets, or they behave as a risk asset, which makes, they're alternative in the sense that they're different, but they're not alternative in the sense that they offer you kind of diversification benefits when you need it, when the equity market does poorly. So I think those are the broad views on alternatives. And then maybe if I can jump to another question, which you might have asked around correlations, I think the high level qualitative comment would be that if you look at US bonds versus equities, clearly they weren't highly correlated this year. So that kind of lower correlation seemed to remain in place. Hopefully, if the equity market comes off a bit, US bonds and treasuries will offer you some protection. The potential problem there obviously might be if concerns about US fiscal health dominates the view then, and for some reason cause US treasuries not to behave like they did in the past, but certainly so far this year to the upside for equity and the lesser performance from bonds, that correlation seems to have been low. And similarly in South Africa, our equities, gold and bonds have done well this year, so correlations have been quite high. Emerging market bonds is a bit more of a risk asset, but again, if there's equity market weakness, one would hope that gold would play its normal kind of protection role in portfolios.
Yeah, thank you very much for that. I think we've overstayed our welcome. If I look at the clock at the moment, it's been very insightful indeed. We've covered a lot of ground. I think there's a lot of more specific areas that we can unpack perhaps in another session, especially when it comes to manager selection, incorporate some of these ideas in client portfolios. I'm going to pause it now. I want to thank you both for coming on this morning and sharing your thoughts. And to our audience, you know how it works. If you want to engage further with Apex Investment Consulting, let us know and we'll get you in touch. I see there's still a couple of open questions. We'll try to get some comments on that as well. Devonga Pierre, thank you for your time this morning. I'm looking forward to engaging with you in 2026 again. Thank you so much.
Thanks, Eugene. Thanks for having us.
Thank you. Thank you, Eugene.
Right, to our audience, thank you so much for your continued contribution from the entire BCI team. It's been a wonderful year. It's sad that we have our last session for the year, but I think you all are going to take a well-deserved break. And we want to wish you a very blessed festive season. Spend some good quality time with friends and family and get refreshed and ready for 2026. We're ready for 2026. We've already planned a big lineup for boutiques on Wednesdays. The first one's going to start on the 21st of January 2026. So we are going to continue with that and keep you informed as we progress. And keep your eye out for the save the date dates for our conferences that will start in February, where we've got again a significant lineup of top quality fund managers to keep us informed on their views, how they see the world, and what they think where the opportunities are for you and your clients. Thank you again for dialing in to Boutiques on Wednesdays, and looking forward in seeing you all in the near year. Be blessed, and thank you so much.
You better not cry, you better not pout, I am telling you why. Santa Claus is coming to town.